Lots of economic and market news this week. We're going to dig into a few headlines and what it might mean for investors. Number one, the U.S. economy grew faster than expected during the second quarter. U.S. gross domestic product, or GDP, grew at 2.4% during the second quarter. This was better than expected and good news, at least on the surface, as it demonstrates that the U.S. economy is growing. We have heard the Fed, care of Jerome Powell, talk about a soft landing. That is, the Federal Reserve's aim to avoid a recession during their tightening cycle. It remains to be seen if soft landing is the new transitory. Digging into the numbers a little deeper, however, we find that the personal consumption component of GDP actually slowed in Q2 compared to prior quarters. Slowing in consumption in an economy where consumption makes up 70% of the economic activity is an indicator we're watching. So if consumption is pulling less weight, what is pulling more weight to get to this better than expected GDP growth figure? The answer? Gross private domestic investment. Now that's a mouthful. Again, that's gross private domestic investment. Think of this GDP component broadly as investments intended to create more growth and productivity in the future. As an example, a business that builds a new factory or machines to improve future productivity. This fixed investment component pulled more weight this past quarter. That was good news for Q2. However, we know that this component is also more volatile from quarter to quarter and less stable than consumption. A steadily growing consumption component rather than a decline would have been a better signal of economic health. From an investing standpoint, increased economic activity is generally positive for stock investments. There is more than one way to get there. Number two, this week the Federal Reserve approved a 0.25% interest rate hike. In an attempt to continue combating inflationary pressures while managing the broader jobs market, the Federal Reserve approved a much anticipated 0.25% interest rate hike. This brings the benchmark borrowing costs to their highest level in more than 22 years. For investors, this decision could mean slightly higher returns on certain shorter-term investments, but we emphasize the importance of carefully managing a balance of investments that generate income today versus investments designed for longer-term growth and outpacing inflation. And finally, number three, the Dow Jones Industrial Average has seen an impressive 13-day winning streak, marking one of the longest runs of gains since before the turn of the 20th century. Looking back through history, on any given day, a market gain is nearly a flip of a coin at 53% of the time. Now, by extending the look-back window to 5-year periods, stock markets were positive 90% of the time. While we like that markets are steadily rising day in and day out, we acknowledge that consistently doing so is abnormal. This is in large part why we at Vector maintain longer time horizons with stock investments.